Welcome to Alpha Insights. I'm Kristen, upbeat, a little curious, and ready to make volatility feel less scary. Quick housekeeping. U.S. markets are closed today, so when we talk prices, we'll reference things as of Friday, February 20th, and the next trading day is Monday, February 23rd. And remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks for having me, Kristen. Great to be here.
Okay, Jonathan. People throw around the VIX and call it the fear index. But let's start simple. What exactly is the VIX, and why should listeners care?
Right. So, the VIX measures the market's expected volatility for the S&P 500 over the next 30 days. It's built from option prices, so it's forward-looking. When the VIX rises, it usually means option buyers are paying for protection, which often happens during sell-offs. That's why it earns the nickname of a fear gauge.
But there's realized volatility and implied volatility. Tell us how those are different in plain English.
Realized volatility is what already happened. You measure past swings in price, like the standard deviation of returns over a window. Implied volatility is what the market expects going forward, and the VIX is an implied number. If implied is much higher than realized, options look expensive. If realized moves above implied, markets are catching up to an event they didn't price in.
Got it. So the VIX can spike, but that spike doesn't necessarily tell you direction, just bigger moves, right?
Exactly. A high VIX means the market is pricing in large moves in either direction. Those spikes often come with downward pressure because investors rush to buy downside protection.
People also mention term structure and contango or backwardation when talking about VIX futures. Can you unpack that without making my brain melt?
Sure. VIX futures come in months, and their relative pricing creates a curve. In normal, calm times, forward months tend to be a bit higher. That's contango. When the front month is pricier than later months, that's backwardation, and it's a red flag. It signals short-term stress. Why it matters. ETFs and exchange-traded notes that try to track VIX futures buy front-month contracts and roll them. In contango, that roll often loses money over time, which is why those products tend to decay for long holders.
So those VIX ETFs aren't buy-and-forget hedges?
Correct. They're useful for short-duration tactical hedges, or for traders who actively manage positions. Holding them as a long-term insurance policy usually eats returns because of roll costs and the way futures pricing works.
Okay, walk us through the practical toolbox. If I'm an investor and volatility picks up, what are the real moves I should consider?
Good question. First, don't panic and buy protection blindly every time the VIX rises. Think in terms of objectives and cost. Tactical tools include buying puts or put spreads on the S&P 500 ETF or on individual stocks like Apple, using collars to offset premium costs, or short-duration volatility products if you truly understand the risks. At the portfolio level, consider volatility-aware position sizing, disciplined rebalancing, which means buying weakness and selling strength, and keeping a liquid cash buffer so you don't get forced to sell into a spike.
I mean, when you look at the data, how do you size a hedge without blowing your returns on premiums?
Use scenario analysis. Estimate possible drawdowns you want to protect against. Pick a time horizon, and budget an acceptable insurance cost. Instead of buying one long-dated, expensive put, consider a ladder of expirations or put spreads to reduce cost. The idea is to cover the portion of risk that matters to you, not to chase perfect protection.
And liquidity. People often forget that during volatility, there's less of it. How should listeners plan for that?
Exactly. Volatility often comes with wider bid-ask spreads and thinner depth, which raises execution risk. Use limit orders, stagger exits, and size positions so any trade won't move the market. Have a plan in place before things get chaotic.
Yeah. Yeah, that's a good point.
And a couple of common mistakes to avoid. Don't treat the VIX as a standalone timing signal. Don't hold long VIX futures-based products as a passive hedge. And don't ignore hedge costs. Also, don't confuse single spikes with structural regime change. Look for confirmation from term structure, credit spreads, and liquidity metrics.
Quick reactions. Tell me in 2 sentences, what's the simplest action a long-term investor can take to be volatility ready?
Keep position sizes aligned with your risk tolerance. Maintain a liquid buffer to avoid forced sales, and set a predefined hedging policy with a budget for premiums. Rebalance regularly so volatility becomes an ally, not an enemy.
Love that. Make volatility work for you, not against you. All right, let's wrap with 3 quick takeaways for listeners.
1. The VIX measures expected 30-day volatility for the S&P 500. It signals fear, but not direction. 2. Use the VIX with other indicators: term structure, put-call flows, credit spreads, and liquidity to separate noise from real regime shifts. 3. Have a plan. Volatility-aware sizing, disciplined rebalancing, and predefined cost-aware hedges beat reactive trading.
Perfect. If you want to dig deeper or ask a follow-up, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks so much, Jonathan.
Thanks, Kristen. Great conversation.